we now have this question of, is there a zero-sum game between net zero on one angle, so hitting the 2050 path, and on the other side, energy security, affordability, the macro issues around supply chain, inflation, et cetera, and system resilience, right? So those, it used to be, the discussion used to be, you can do all of these things, you can optimize, which is what I think Luisa is referring to, like really reduce the methane footprint and the carbon footprint of the oil and gas companies. Now the discussion is there a zero-sum game between these two factors?
I wanted to start sort of with a bold claim made in the Financial Times recently by the CEO of Chevron, who told us that the current energy crunch crisis, whatever you want to call it, is actually the fault of Western governments. They went too far, too fast on green. They made oil and gas uninvestable. Luisa, do you agree?
I think it's better to start with the following sentence. The energy crunch is multifaceted. It's not just due to one specific thing. It is also the case, yes, that there is underinvestment in oil and gas, or less investment in oil and gas than it has been in the past cycles. But that is responding to a sector that is adjusting to what it sees is an outlook for the energy transition. What is not happening is the same levels of investments that will need to take place in the renewable space as if we were going to the energy transition. They have increased investments and deployment of renewable energy, but not at the level that is needed as if we're going to net zero. And so that has created an energy imbalance that we're seeing with the energy crunch, and it has being exacerbated by the war on Ukraine. So I would say that it is also the case that we have focused too much on energy supply, and we have not focused enough on energy demand. And so I do think that, or I'm hopeful that this discussion about the energy crunch is going to lead to a more balanced approach to the energy transition, so that we look at the transition aspect of the energy transition and not only the net zero aspect of the energy transition. Both are extremely important, but they are both important.
Okay, thank you. Robert, same question.
So look, Luisa is an expert on energy. I'm not. This is Michael Wirth, right?
Correct.
The Chevron CEO?
Yeah.
That guy. I think this is hilarious. Okay, I mean, it's absolutely hilarious. So this is the guy that got the letter from Vivek Ramaswamy saying he wants to make sure that he's allocating enough capital to oil and gas. I don't know much about Chevron. I follow ExxonMobil a little bit because I followed the Engine #1 campaign because Charlie Penner is a friend of mine, and I think he did a brilliant job. And I've written about ExxonMobil. And so just for fun, I looked at their Investor Day presentation. I think it was in March. It was a completely rosy picture. There was no complaints about being under pressure not to drill for oil and gas. They're going to have $100 billion in free cash flow over the next 5 years. They talk about how they're managing for the energy transition, and they're going to have, more renewables, and they're doing hard carbon capture and storage and this and that. If you look at what's going on with the oil and gas companies, the shareholders, it's not governments, the shareholders are telling them to allocate more capital to dividends as opposed to exploration. And so that's a choice that they make, and they're making their own decisions. So I think for Mr. Wirth to be pointing fingers at some unknown government pressure that's on the oil and gas industry, that it's underinvesting to produce energy, is ludicrous.
Well, I assume, he would cite things like pipelines, pipeline permits, drilling on federal lands, those sorts of things that the oil companies are always asking for.
I don't get down into the weeds of, the permits and the pipelines and stuff, but what I do know is that they are, returning more money to shareholders in dividends, and none of them, if you go and you look at their presentations, and ExxonMobil is kind of the big dog in this, you don't get any sense of pressure whatsoever from the government that they are not, being given the permission to go drill for oil and gas. You guys, you're the ones that talked to him. Huh?
We talked
You
to
gave him this platform.
I don't know if it was a
You
platform.
own it. I mean, look, it's great. But I mean, it's going to be interesting to see.
all sorts of people,
And you should.
including CEOs of big
I think it's good.
companies. Yeah.
I think it's good. But I think it's hilarious.
Do you think that it's Western governments that are to blame for the crunch?
I think if I look at the crunch itself, you could say fossil economics are a big driver of that. So cheap Russian gas, which drives a large part of the German economy, the European economy, was economically attractive. You could say there are limits, environmental limits on gas permits, et cetera. But when you look at the economics of the Russian flow versus the comparative economics of other resources, either gasification of LNG into Europe, or even from the Netherlands, Norway, there's still a big case economically to make for Russian gas. So it was economics in a lot of ways that made the gas flow. And if you look at German building consumption using gas, or Italian power sector consumption of gas, those things didn't really go down extensively over the last decade. So the economies are using gas, and you think back to the bridge fuel economics discussion, but it's Russian cheap gas that was driving it. And there's a dependency, and you could look at 2014 and say there was geopolitical risk in the system always. In 2014, with the Crimean War, was a big signal, and nothing really shifted. So economics continued to play the game, and now we had this black swan event of the invasion this year, and now we're dealing with prices. So I could explain it that way as well, that it is the fossil economics that go through it. Now, one point that comes up often is when you go back to the German decision of shutting the nuclear plants after Fukushima, that set the grounds for this. And remember, that decision was not just an environmental decision, it was a safety decision made by the government based on what was happening in Japan. So I think it is very nuanced, as Luisa says, but there's a whole economics argument to it that we can't really shut out. That's what was driving a lot of the competitiveness of these economies.
I mean, Luisa, was there, in the sort of, rightful rush to net zero, a sort of failure to realize that so much of the world's energy supply was in the hands of autocrats, hostile nations, and who can wage war or hold economies hostage through OPEC plus?
So,
I think you might need to use your hand mic, sorry.
My mic.
Yeah.
So the world today, the primary energy requirements of the world, 80% is fossil fuels. That's the world today. That is the world that we want to transition from, right? Oil and gas is 60% of primary energy requirements today. Geopolitics has been a constant feature of global energy markets. This is not new. I just think that probably we underestimated the geopolitical risks of the energy transition, so we are adjusting for it. And so I think it's important to remember that in this net zero world, it's not a world where we are going to consume and supply zero oil. In that net zero world, the International Energy Agency has as a probability that the world is not going to consume 100 million barrels per day, but 25 million barrels per day. But guess what? Those 25 million barrels per day are going to be supposedly consumed by or produced by the low cost, low carbon intensive barrels produced by OPEC countries. And so is this the world that we want? And so today, the oil, 50% of the oil that we consume, the oil that is produced in emerging markets by national companies. More than 50% of the refining capacity that the world has today is in emerging markets controlled by national companies. And guess what? That is going to increase. And so in our understanding of energy security and our understanding of energy transition, these are things that we have to factor in. There is oil and gas that we are going to consume as enablers and in support of the energy transition. Who is going to produce those oil and gas? Who is going to refine those products? And so there is a case to be made for how we think about the transition aspect of the energy transition to actually make the energy transition the most orderly possible. But we also actually need to care about the carbon intensity of each barrel of oil and each molecule of gas. And so the discussion about ESG is also a discussion about ESG in the oil and gas industry. And so to me, it's not about, the oil and gas or ESG only apply to the oil and gas publicly listed companies in the Western countries. It is about applying ESG to the whole industry so that we level the playing field so that each and every barrel and each and every molecule of gas is produced with a less methane intensity and with a less carbon intensity. Because we have a limited carbon budget and we cannot wait for net zero to also deal with the oil and gas industry.
Mayan, is that happening? Are you seeing that happening?
I think the progress is not going to be fast enough based on the economics that are happening. I mean, the way I look at it is, we now have this question of, because of the Ukraine crisis, we now have this question of, is there a zero-sum game between net zero on one angle, so hitting the 2050 path, and on the other side, energy security, affordability, the macro issues around supply chain, inflation, et cetera, and system resilience, right? So the discussion used to be, you can do all of these things, you can optimize, which is what I think Luisa is referring to, like really reduce the methane footprint and the carbon footprint of the oil and gas companies. Now the discussion is there a zero-sum game between these two factors? The way I think about it is there are still a lot of net win areas. So if you think about renewables, the lower cost of marginal production and the flexibility of the system, meaning storage, energy storage, things that stabilize a renewables-based system, those are things that are still in money. We still have steel companies and customers that are willing to pay a premium for green steel and willing to buy carbon offsets, right? So those things will continue to drive progress. There are going to be areas that we're going to need to tweak. So if I think about affordability, the implicit cost of carbon coming in, maybe some of those things will have to slow down or will slow down based on the pushback. If you think about nuclear, there's a resurgence of nuclear that will need to be thought through, because this view 5 years ago that nuclear is out is now being re-questioned, I think for good reason. So you think about those areas where there's a bit of tweaking. I would say if you look at the IRA, just to make a point there, the IRA in the US in some ways is actually a push to say industrial policy really takes climate economics and puts it at the core pillar, makes it a core pillar of the economy. So we're seeing different reactions to this issue of, is this a zero-sum game? The two other points I would make on this is, to get to 2050, this decade is important to make big investments. And I think those investments will slow down. So there will be some hesitation and pullback. And so we have to really question, will the path to 2050 really still be there, or is there going to be an extension of that time frame? And therefore, to me, the focus on adaptation really needs to start to shift faster, which brings into question more the global south and north question of who really funds the cost of climate and how does that get funded over time. But the adaptation piece, to me, becomes much more important as we think about the challenges right now.
Cool. Robert, I'm sort of sensing an agreement here that at least needs to be some tweaks on the path towards net zero, if not an extension, which we can come back to in a moment. Do you agree?
I do agree. I mean, I think Luis is absolutely right to raise the national oil companies. Not enough attention is paid to them. So there's all this focus on Chevron and ExxonMobil and ConocoPhillips and whatever, BP and Shell. There's no investor pressure on national oil companies, even if they're listed companies, because they're still controlled by the state. And I've done a little paper with my friend Shivaram Rajgopal at Columbia. We looked at a carbon tax. Like, what do carbon tax do? The national oil companies, those countries aren't going to apply it. And if you did, most of the Western oil companies would be out of business, except Saudi Aramco. It is the lowest cost producer by far. You walk across the desert in Saudi Arabia, and oil just like comes out of the ground. It's like $4 a barrel or something, right? It's crazy, right? And so there's not enough focus, I think, on the national oil companies in the geopolitics. My panelist is right about nuclear. This has been one of these kind of ideological things. We're not going to have nuclear. No, you're going to need to have nuclear. Germany's screwed, not just this winter. Their bad winter is going to be 2 winters from now, because all the stuff that's in the stores are going to be gone. Angela Merkel made her bargain with the devil with Putin, made this decision on nuclear. France has all kinds of nuclear power, and they run it very safely, and I think it's fine. The IPCC says we're going to need to have nuclear. And so what you've got are these good intentions that are just not practical. We're going to have coal. China said, we're going to keep using coal, and India's going to keep using coal until they've got renewables that are cheap enough. And so I think we all need to step back and sort of maintain a commitment to what needs to get there by 2050, and I agree with my panelists that this decade is important. But you just are creating an equation that's got too many constraints. When you take coal off the table, and you take natural gas off the table, you take fracking off the table, you take nuclear off the table, you just can't get it done. And only in the past year or two is this notion that Louisa mentioned, again, energy security. And that's a big change. And I think this notion of energy security is going to start driving this conversation a lot.
So one thing that I think this crisis has brought to the attention of emerging markets, which, by the way, this is where we're going to meet or not our climate targets, what the emerging markets do. So the last panelist from the UN was absolutely right. But I think this energy crunch, what has meant is that in emerging markets now, there's an equation between sustainability or clean energy, energy affordability, and energy security. Those three things were not in the discussion together. This is now very clear for everyone in emerging markets. We're not oil and gas producers, that the path towards energy security and energy affordability is through renewables, and that is very powerful. Mm-hmm. That is actually a much better way to commit. There is issues with access to finance, and we can talk a little bit about that later, but what I would say is that I don't see it as a zero sum. I just see it that in this, whether the crisis has backtracked or advanced, the energy transition, it has done both at the same time, because there's an energy security impediment, necessity right now that you have to figure out. But my sense is that it has significantly made the case for renewables.
Can I make one?
Go on, please.
Sorry, just one question on renewables. I think I find the discussion on renewables to be often quite naive, because yes, renewables, we need renewables, and no doubt the marginal costs are, the economic case is there. It's a job creation machine. It's all of that is good, but you can't just invest in renewables without investing in transmission, without investing in system resiliency, flexibility, changing the market designs. That stuff does not get discussed. People just focus on renewables, just like people focus on oil and gas. But all of the enablers have to be in place. So, for example, the IRA basically would unleash another 700 gigawatts of renewables in the next decade, up till 2032. But the transmission build is not addressed at all in the IRA to actually enable that. So we're not going to get 700 gigawatts of renewables. We're probably going to get 200 gigawatts of renewables at the current pace of the enablers. So as we talk about renewables, I think policy focus on what is the enabler of that is also quite critical.
There's one other thing that's unrealistic. This carbon capture and storage Hail Mary pass technology is going to save us. So I was at a conference a couple of weeks ago, and people were talking about natural capital solutions, for capturing carbon. And it was a bunch of experts, and I understood about 10% of it, right? So what did I remember? What I remembered was, at best 20 years from now, the technology will be cheap enough to do carbon capture and storage at even a modest scale, let alone a significant enough scale. And so, you've got this sort of thing out there where it's like, okay, they don't have to worry about it so much because there's going to be all this carbon that you're talking about, but this technology is going to come along and it's going to bail us out. And ExxonMobil's, kind of pitching that this big facility that they want the government, I think, to provide most of the funding for it. There's not enough realism in this discussion, and there's a lot of naivete, and there's a lot of ideology on both sides.
Do you agree?
I think the magnitude of the challenge is one that you have to try everything. So I'm of the view that it's the kitchen sink that you have to throw this. Something will stick, and you have to try everything.
Kind of a new take on all of above.
All of the above. It's not one versus the other. It's not hydrogen versus CCUS. It's everything.
Yeah. Mike, I wanted to come back to a point you made, which is, kind of pull back on investment. Is there any scope to catch up in time, or do you think the date will have to be pushed out?
There certainly could be. And what would drive that is technology innovation and policy to a certain degree. So if you go through, on the policy side, if you go through all the fiscal challenges that we are seeing right now and the funding that is going in. So the kitchen sink costs money, right? So all of that goes in, it has to be raised. But as growth comes back, because it will come back in the global economy, then do we catch up from a policy perspective and then fund the other side of this, which is acceleration. And then on the technology side, the CCUS technologies, hydrogen, et cetera, you're right that the break-evens are showing 15, 20 years. I bet if I showed you the cost curves for solar, and when, you guys know this, if I showed that to you in 2000, we would have seen a 30-year kind of break-even in a sober analysis, and we know what's happened. So it's hard to tell whether how fast those will go. What we do know is if we do give some impetus, as a number of different countries, a number of different policies are now pushing technology use, the kitchen sink argument, they do start pushing, historically, they do push technologies faster than we thought. So net, if global recovery happens, do we then fund the acceleration? If technology innovation happens, then there's a chance to catch up. But I come back to, David, the question of adaptation. We do have to prepare for adaptation much more seriously.
I completely agree with that point. And also, I will come back to emerging markets, that it's only not about investing in mitigation and investing in adaptation, given that that's where most of the vulnerabilities to climate change are occurring, regardless of how fast we're going with the energy transition. Climate change is, we're seeing the impact of climate change, but and I hope this is at the end a discussion about ESG. And I study the financing of the energy transition in emerging markets, and one of the things that is clear to me is that the level of institutional transformation that is needed in emerging markets in order to be able to capture the financing sources that exist, both on the private side and on the public sector side. All of the money that is available, you do have to, you need a policy enablers. It's a whole new institutional framework that is about policy enablers for all of these new type of energy technologies and the enabling infrastructure for the development of these technologies that require that emerging markets learn how to talk the talk, understand how to also talk about carbon intensity, understand how to measure this. It doesn't seem to me an option that you can opt out. It's something that we do need to invest in helping them navigate the complexity of all of these reporting or of all of these metrics and how to measure them, because it's going to determine their ability to access finance.
And how do you do that? Is that funding? Is that people? How do you get them the competencies?
I'm encouraged by what I see from the banks that have decided to take an engagement versus divestment type of strategy, because it does require a lot. And in looking at what financing the energy transition looks like, there's a lot of technical support that is now coming from the multilateral banks and from the gentleman from the UN development, from the UN as well. There's a lot of technical capacity that is going in order for the emerging markets to be able to scale up on understanding how to access and how to understand the carbon intensity and the energy transition frameworks that they want to adopt.
Can I just build on two comments my panelists made? So on this point around adaptation, you're absolutely right. I mean, we're not going to get 1.5, right? It's probably going to be 2. It's probably going to be more. I go to my friends that are like, really locked into this space, and I go, we need to talk more about adaptation. And they say, we can't do that because then there's not going to be enough focus on the mitigation. And it's like, no, that's ideology again. That's not being practical. No, you're going to need to have adaptation. So let's just admit it. We're going to have nuclear. We're going to have to have adaptation. And divestment is a joke. I mean, I've done research. Other people have done research. It feels good. It's good press. It makes no difference whatsoever. The engagement is a solution. And okay, so you're going to divest. Let's say we put all the Western oil and gas companies out of business. Okay, great. Then we're back to your national oil companies. Yeah. So what's the logic in this? There isn't any.
Well, I think we're touching now on a slightly different debate, or at least sort of moving towards it, which is the sort of domestic rancor around ESG. The sort of, you mentioned Vivek Ramaswamy, Mr. Anti-Woke, and then the sort of the funds and the banks that have distanced themselves from their green, their sort of love of green until recently. Is that a flash in the pan, or is that now a new thing that, in addition to the sort of global picture, that has to be factored in? Robert, what do you think?
So I think some of this stuff will be a flash in the pan. I think some of this stuff, step back, look, I think there's a constructive debate to be had about ESG. So we'll leave aside, kind of the Vivek crowd and then the Taliban crowd. I like to think about it. I wrote a piece called The Topology of Hate for ESG. And in that set, you have the sustainability Taliban. And then you've got the sustainability flat earthers like the Republican Study Committee. And then you've got sustainability sort of advocates who become opportunists. And I'm one of the few sustainability pragmatists, I think. So what did they do? 10 years ago, you go, ESG. I don't even know what it is. Then you explain it. I don't like it. Okay. Well, let's do it. No, I'm going to lose money. The fund's going to lose money. It's like charity. No, it's not. So then I do research. George Serafim does a lot more research. Actually, you focus on the material issues, not everything. ESG funds, the performance can be pretty good. It's like, okay, then here was where, the Rubicon was crossed that created the problems. People said, and it was like DWS, 70% of their funds were green. They throw my friend Desiree Fichtler under the bus. She won in the end. Do this ESG investing. You're going to make more money, and you're going to save the world. You're going to make the world a better place. It's like, who wouldn't want that trade? I can make more money, and I can feel good about myself. That was when the problems became, because what happened is that two very different things got confounded. ESG integration is basically the single materiality. It's a company's operations and activities, and that's related to enterprise value creation. Making the world a better place, if you want to look at it through the lens of the SDGs, which more and more people are doing, that's basically about the positive and negative externalities of a company's products and services, right? So in oil and gas, they can be really buttoned down. ExxonMobil's really buttoned down as an operator. If you look at what the SASB material issues are for oil and gas exploration and production, they're really pretty good. The controversies around the externalities are being created. So I think this kind of over-enthusiasm and overselling, and so, the FCA just came out the other day, my friends there, they've come up with trying to sort of get some better labeling on it, SEC is working on it, Europe has got SFDR 89, so I think those things are constructive, right, and to try and get some clarity about the difference between ESG and impact. But then there's the political theater part, right, and this is where I think the term ESG, may be past its sell-by date, because when you look at it, it's fascinating. And I first was attacked by the sustainability Taliban over integrated, it's like a long story, but man, they ruined my page on LinkedIn, and then I learned about trolls through a millennial, and I blocked them, and they went away. They're like, what the fuck, Bob, are you saying this and that and the other thing? It's like, it was crazy shit, man. It was about a little article in the Harvard Business Review saying the International Sustainability Standards Board is a good idea. They launched off. They don't like ESG because it's just about enterprise value creation. So, okay, these companies are making all this money, and they're destroying the world. Then you've got Mike Pence, who comes up with his editorial in the Wall Street Journal in May, the House organ, and followed up a month later by the Republican Study Committee issues the memo, The War on American Energy, Ground Zero. And they go, ESG is this progressive left-wing insidious movement to basically destroy the American energy industry and to make companies less profitable. And then Vivek comes along and he goes, oh, all this woke stuff, is making companies worse and this and that and the other thing. This is political theater. And so you've got Chuck Hagar in Texas running on this, all the exclusions. You've got DeSantis. Ron DeSantis in Florida goes, legislation, we're not going to have any ESG in our funds. What does that even mean? How would you know if it was there or not? What are you going to go look for? Who are you going to send into your funds to get rid of the ESG stuff? What it's become is a topic that is highly energizing in the base. So they put a definition on ESG that it was never intended to have. They dislike it for the completely opposite reason of the Taliban. So it's like guns, it's like abortion, and so it's become highly, highly politicized. To what I think will happen over the long term, the political theater part will probably go away. Rationality will come to place. I've talked to Vivek. He's an interesting guy. He's a smart guy. He went to Harvard. He's got a degree from Yale Law School, so it's good. But I've watched his funds. All right, it's very interesting. So he launches Drill, which is basically drill, baby drill. And if you look at it, it's like, all oil and gas, and it's, concentrated in about 10 companies. So it's an ETF at 61 basis points. That's an expensive ETF. And real quickly got to 300 million. And then it's kind of gone flat. It's down to about 284. I don't know how much of that is, stocks, how much is, withdrawals. You're not gonna make a living on a $300 million ETF. And then he launched Strive, which is the anti-woke version of the S&P 500, whatever that means. And, that's now at about 38 million. So that's twice as much as the Bridgepoint Put America First Fund MAGA, which is 17 million, and it's based upon, your Republican values, and so they select companies that give a lot of money to Republican PACs. There's a market test that's going on, and so I think that's very useful, and let's kind of see what happens. The other thing that's happening, this is a little bit wonky, is to see how the people that are kind of on their anti-ESG crusade, because it's this left-wing exercise, are twisting the notion of fiduciary duty and completely misinterpreting it. So I think you're going to see, as people focus on what fiduciary duty really means from both a company and investor perspective, I think we'll get some clarity on that.
We've got lots of things there, but one of them is that ESG itself is becoming a sort of unhelpful label. Is it time to find something else?
I don't know if we need to look another label, to find another label, but I find it very useful. In particular, again, I'm going to go back to emerging markets. We maybe are concentrating only on E in advanced economies because maybe we have already the G, right. In emerging markets, it is the governance that is the problem. And if you don't have governance, you are not going to get anything else right. So it's a fundamental, set of category. And to me, that I've lived in this space of emerging markets and energy finance, you always knew that risk premium that you have in emerging markets, it was a black box. You didn't know what it was, but it's really about governance issues. And so to actually label it, to understand the metrics, and to look at the research that has been going on for decades about governance and the importance of governance on firms and companies' performance and valuations. This is not just something out of the blue. Governance issues have been studied for significant amount of time. You just brought it together in the ESG, and yes, there are some questions about how do E, S, and G go together, and what does it tell you that a company has good ESG performance? What does it say about its environmental performance or its governance? So ESG wants to be a lot of different things, and to me, ESG performance evaluated as a whole maybe tells you about tells you a lot about a company, but maybe it's not very useful to understand both the weaknesses and the strengths. But I do find it very valuable to actually look at these things and provide a roadmap for, okay, let's look at national companies, let's look at state-owned companies, let's look at the board. Who is in the board? How is this selected? Are these political appointees? These things are useful. What is the level of competence? So to me, it remains a very useful way to think about sustainability and to help other companies and companies in the emerging market world look at a roadmap of how to become sustainable companies.
So it sounds like it's useful still for companies and investors. Is it a good public-facing term for, for people whose houses have been swept away in Fort Myers in Florida to understand that their pension funds are being told to disinvest from companies and technologies that might be, hoping to avert such a thing happening in the future?
I think why don't we
Yeah, Hamaya, do you want to take that one?
So to me, there's a natural evolution of this, what ESG represents, which is an amalgamation of things. And I agree with Luisa. There's a global south view of it, which is a slightly different view, which focuses more on the SG. There's a global north view, or ECD view, which is more of the E. But is it representative of those folks who are losing their homes? I don't think it's representative of that. It's not a full measure of the risk of that. But if I just say, when I say natural evolution, if I just go back to the economic crisis of 2008, 2009, and then we had the income disparities starting to change again globally, and the whole discussion, Occupy Wall Street happened, the whole discussion around the purpose of business, then that transitioned to stakeholder capitalism, which nobody could really understand what that meant. The quantitative representation of that, in a lot of ways, was ESG. That's what people could start understanding. So it's good in the sense that it presents a set of facts for interpretation, but it's going to continue to evolve. So it does need to evolve to a place where we can find more materially ways to figure out where do we do the investments, what are the criteria behind that. But I think it's been helpful, but it has to continue to evolve. That would be my view. It's not representative of the question you asked right now on the Fort Myers example.
Robert, did you want to comment?
I don't, to be honest, quite understand the question about Fort Myers.
Well, my question was that, you have, it's become a whipping boy for DeSantis.
Yep.
There are people, presumably, who've lost their homes in Fort Myers that, are worried about hurricanes, floods, etc., whose pension funds whose funds are being disinvested from these companies, or at least as an attempt to do so. And I'm just wondering, if a new way of talking to the public is needed.
So the first point isn't exactly accurate. It's political theater. So again, my buddy Shiva, who does empirical work, I just kind of rattle on about stuff. He does serious research. He looked at the Texas pension funds, and it's kind of a bigger deal down in Texas, to see if there was any major changes in their holdings, and there weren't. Okay, so it's like you go at that, and what happened to Texas is they went and they, with great fanfare, said these 6 banks, can't bid for this municipal bond offering. You're excluded because you're not fossil fuel friendly enough. Okay, great. And so they do this bond offering, and the smart guy at Wharton does this paper saying it's going to cost them between $300 and $500 million in additional interest because they had one little kind of mid-market bank go into it. Oh, so then what happened? Well, 2 of the banks are already kind of back in. And I'm trying to get this in the public domain. I know people. And the other 4 they're talking to. And so everybody's going to kind of like quietly just sort of agree. So they got the political theater. So Chuck became controller again for the 3rd term. Then they let all the banks back in. So I'm not so sure, that the economic consequences of this are going to be all that great, because I don't see any sort of material changes that are taking place. And if you look what happened in Texas, they have, here's these 10 institutions that they're not going to let them manage their money. There's only one that's American, it's BlackRock, has become the whipping boy for the right and the left. And it's a bunch of Scandinavian funds. They don't want to manage money for Texas anyway. And it's like, okay, whatever. So you kind of excluded these 9 funds that don't want to have anything to do with you in the first place. I mean, what's the big deal? So I think the political theater element of this is kind of important to recognize. How much kind of things are sort of changing on the ground is less clear.
But I agree with Robert that the backlash might be very useful from the point of view of constructive criticism, of understanding the shortcomings of ESG and evolving. And so whether the label itself, ESG, is going to remain or is going to become sustainability, I don't know. I'll let others figure that out. But what's inside and the ecosystem that ESG created, to me, tells me that this is moving forward regardless. And that the political backlash might be an example or underscoring its success rather than the opposite.
And I think the political backlash needs to be addressed directly. Do you mind if I ask the audience a question?
Go for it.
Can I? How many people in here are Republicans? Okay, one in the back, gentlemen. In the back of the room, it's where I belong. That's good. How many people know a Republican? So that's pretty good. So I'm launching with a Republican friend of mine, my GOP outreach campaign that came about because I wrote a piece called Grift Capitalism, the GOP's brilliant strategy for ripping off ordinary Americans. And I thought it was lovely. And this lawyer friend of mine in DC writes me and he says, Bob, I'm disappointed in you. The piece is beneath you. You're just adding fuel to the rhetorical fire. Why piss off Kevin McCarthy when he's going to become Speaker of the House and the Supreme Court isn't wrote? So I wrote back, thank you for your note. I didn't start this fight. I'm Kevin McCarthy. I'm nothing to do about that. Doesn't know me. If he did, he wouldn't like me. Put the Supreme Court aside. So we said, let's chat. So he goes, look, I think sustainability is absolutely fundamental. You've got to start there. He said, Bob, what you have to understand is that in the Republican Party, if you say sustainability, so I'm not so sure we're going to be able to go with sustainability, they go AOC, Green New Deal, Europe, Marxism, and I don't like any of that, okay? And so I'm thinking, okay, I don't see it that way, but that's interesting. And what I think needs to happen, and I'm dead serious about this, and I've met some, pretty prominent Republicans, and they're all kind of quiet conversations, behind the group called the Bipartisan Policy Center that's formed the Senate ESG Working Group. We need to change the language that you're using, our fellow panelists talk about energy security. You need to just kind of take out sort of, the ideological rhetoric, kind of focus on issues, talk about nuclear, talk about coal, talk about adaptation, talk about energy security, because this fight isn't getting us anywhere, and having everybody kind of talk to their clan and feeling good about it isn't getting us anywhere. So I think we need to find a way to have this conversation that says, look, there'll be differences in views and what the right public policy approaches are, how much government, how much market. But if we can't start having a more common and realistic conversation, we're not going to solve the problem that we're all facing.
Any questions, comments from the room? Hi, we have one here. I think a mic is just coming. Or you... There's one here.
Hi, I'm Keiichi Aritomo coming from Tokyo government. As you may be aware, we have a significant social stigma against nuclear energy, starting from Hiroshima, Nagasaki, and Monju, and Fukushima. So it's almost taboo to promote nuclear energy in Japan. But as you mentioned, it's largely caused by governance issue, as opposed to technical issues, right? My question is, how do we, get rid of, political and also social, misconceptions when we talk about ESG, right? And second question is, I spent some time with people from Kazakhstan last week for Casablanca Sustainability Summit. They are the biggest producer of uranium in the world, but they don't talk about the uranium at all. And America is buying a lot of the enriched uranium from Russia too, but I don't hear anything about this. We only hear about the fossil energy. So do you is it sensible to face this reality as to how do we deal with nuclear energy going forward?
I mean, Mayan, maybe start with you. I mean, is this sort of moment a chance for nuclear to for it to become politically more palatable again?
I think it will take time, and I think the specific question of how do some countries who have just not who've had policies to push against nuclear or not adopt nuclear, if the question is how does that turn, I think my view is that if nuclear starts happening, gets a revival, and you've seen probably some of the announcements by Sweden and other countries in Europe that have reestablished their intent to at least explore the nuclear expansion. As more countries start doing it, then perhaps those countries that have decided not to do it would rethink the policy. Germany's all so. But unfortunately, that'll take several decades because to build these plants, the first of a kind, the SMR, new SMR technologies, the Gen 4 technologies will take time, and the financial mechanisms have to be clear. So it's not an overnight thing. It's not as fast as renewables, for example. Obviously, in 2-3 years, you can get deployments done. So I think it will require more critical mass adoption for countries to then decide, okay, perhaps this is the thing we would want to do. And I think so that would be my kind of view on the nuclear piece. I think just one quick thing on the costs. the big focus, obviously, right now is the overnight costs, getting that down for nuclear installation. And we are seeing a lot of activity now and interest around, really prompted by the Russia-Ukraine push, on really private investment coming in as well and looking at deployments for nuclear. And we're seeing market rules starting to also change and differ. You've seen some of the policies, like in the US and Europe, that are favoring that. So the culmination of this does provide that environment, but back to the timeframes, I think are quite extended for nuclear.
Okay, thank you. I see we are flashing red, and I'm conscious that I'm the only thing standing between you and a cocktail. So thank you to all our panelists, and I think welcome Simon Mundy back to the stage. Thank you all. It was great. Thanks.